Okay, we will go ahead and get started here. Thank you for joining us. First of all, I know it's the middle of the day at lunchtime for those of you watching live, so we do appreciate your support and your being here for the live presentation. I'm going to introduce Richard Wilson. He is a great partner of Left Field Investors. Now we are working on the details of all of the things that we can get from the Family Office Club and how we can work together to really help us all become better investors and get increased opportunities and things like that. We will, three of us, Chad and Ryan and myself, we'll be going down to the Family Office Super Summit in Fort Lauderdale in just a couple of weeks. So we're super excited about that. And we'll be going to the Los Angeles Summit in March as well. So all of these conferences will be shared with you guys, Left Field Investors, and you'll be able to participate and go to these conferences as well. And they're really fabulous conferences. Ryan and I went to the one in September in New York, had a great time and made a bunch of great connections. So we are really pleased to have Richard Wilson and the Family Office Club as our partners. And with that, I'm going to turn it over to the CEO of Family Office Club, Richard Wilson, and he's going to talk about short-term rentals and Airbnb today. Thank you, Richard.
Awesome. Thanks for having me here, Jim. Appreciate it. And we've enjoyed getting to know many of you from LFI through our last event and through phone calls between myself and Laura on our team. I just provided a link within the chat here in Zoom for the Family Office Super Summit. But if you're an LFI member, as long as you're not raising capital or syndicating deals or have a fund, you can come to the event at no cost. So just make sure you don't get too excited going to the website that you start paying us a bunch of money to come. That's just a benefit of LFI. And we've really enjoyed the type of people, the quality of people in LFI. And that's a reflection, I think, on Jim and his values and who he is and who he kind of lets into his circle of trust. So appreciate everyone being here today. So again, my name is Richard C. Wilson, founder of the Family Office Club. We've run that investor club for 15 years. Just this year alone, we've closed on $83 million worth of transactions. And our biggest client is a billionaire that we've closed 19 deals with. We also work with some publicly traded entities and billion-dollar plus balance sheets, but a lot of our clients, a lot of our investors are doctors and dentists who are earning $500,000 to $1 million a year, or a doctor or dentist who has sold their practice, or a private business owner who is doing very well or has sold their company. And so we're used to working with people that are 2 to 4 million net worth, 5 to 10 million net worth, in that range. But for the last 15 years, we've been running this investor club. And we've seen that the smartest investors that are worth tens of millions of dollars or much more, they all have one thing in common. They focus on one or two areas of strength for their balance sheet. So for us, we're doing the same. It's what we recommend in our books, at our conferences. So in the operating business world, we only invest into medical and dental practices that are profitable with multiple locations. And in the real estate world, we're only investing our balance sheet capital and time and energy managing real estate assets in the short-term rental space. So the point of this webinar is to share with you what we have discovered as the 10 most powerful strategies for making money in the short-term rental Airbnb space. Some of you may benefit from this and know more, or you may know half of what I'm about to say, and the other half helps for a couple of properties you already own. Some of you may want to go out and invest in one yourself directly. It's totally fine. You can still benefit from this information. And some of you may want to do a combination of investing in our Airbnb short-term rental fund, which gives you access to dozens of properties within one investment, as well as cash flow. And then also be learning from what we do. And you can also do something on your own as well. So I'm going to go through the 10 strategies. We currently have 12 properties in the fund, and we just launched it and had our launch webinar about 8 weeks ago. So we're moving pretty quickly. We've done 5 properties in a traditional sense, and then we co-invested into a portfolio of 7 properties recently. We should hit 13 to 15 properties by year end. We've got some really exciting ones coming down the line. So they get into that as we go. Real quick, some of you have probably invested in mobile home parks. It might look like this if you're following along visually. But you're probably not too excited to go sit on this couch in your free time over Labor Day weekend or Easter weekend and enjoy this investment, right? Not all investments can be enjoyed. If you invested in workforce housing, you may not be taking a dip in the swimming pool in your free time. It's just not a benefit that really comes with most workforce housing properties. But one benefit of the short-term rental space is that some of the most highly profitable assets are really ones that are most unique and most fun or have a great theme to them. But you can't just invest in stuff because it's fun or looks pretty. If you do that, you'll have Ferraris and Miami Beach condos and you'll go broke, right? So what's more important than the look of it is really the numbers behind it. And this is why we like the space. Institutions love things that they can buy in big packages, pension funds, endowment funds, sovereign wealth funds, and put out 25 million, 100 million at a time in nice clean chunks. Goldman Sachs buying neighborhoods for 40 million, 80 million as they get built for SFR, build to rent, buying multifamily properties, storage properties. And so when institutions pour billions of dollars a month into a sector, what do you think happens? It becomes more efficient, it becomes more expensive. And if you can sell a package of properties to an institution, it can be a great thing. But institutions own 25% of all multifamily assets. And they own around 15% of storage assets, but that's quickly growing. But they only own 2.4% of single family residential assets. But you've probably seen a lot of Wall Street Journal headlines about Blackstone or Goldman Sachs or someone buying, or CalPERS buying whole neighborhoods for build to rent. You've probably even seen some investments in this community about build to rent. But despite all those headlines and all that activity, they still only own 2.4% of SFR, which is single family residential homes. What's even less efficient to that is STR, which is short-term rentals. Most people have not even heard the word short-term rental as an industry segment or a real estate food group. And there's not many Airbnb short-term rental funds out there to invest in. And so the level of institutional ownership in this niche is under 1%. And so the reason why we like that is that over time, it is inevitable more and more money will pour into SFR, and then it'll become more and more efficient, and it'll get up to 10, 15% where storage is. Some Wall Street Journal headlines say that in the future, the middle class will all be renters because of all the money going into SFR, that the institutions will own a lot of the houses out there. And then eventually, STR, short-term rentals, will be owned 2%, 5%, 10% by institutions. So we're building up a large portfolio of short-term rental properties so that we have the option to sell to institutions down the road. AirDNA's CEO has been quoted as saying, this business model has been proven, and now the opportunity is to do it at scale. That at eXp Realty, they've been quoted as saying, experts say the transition for institutions is inevitable in the short-term rental space, and it may bring several perks with it. All right, so let's jump right into the strategies for the webinar today. First strategy is to do an all cash offer with a quick close. Right now, a lot of people are wanting to make sure they get sharp deals. But a year ago, if we think back, it was the hottest real estate market the US has ever seen. People were getting 5, 6 all cash offers on their properties, same day, get 3 offers in on their properties. Now it's taking them a few months on average to sell their properties. But in the hottest market the US has ever seen, and in a hot geographical area of Park City, we were able to secure a 30% discount on this cabin you see here. And it's a great cabin. It fits about 16 people in there. Last time we were there for Thanksgiving, we saw a moose every single day that we were there. You're 10 minutes from the ski slopes. You're only 17 minutes from the Salt Lake City metro area if you want to go out to dinner or drive easily from the airport. And this property was listed for $1.33 million. Somebody offered cash on this property and one other, and they broke the sale on this one. So we started negotiating when it was at 1.25 million, and we bought it for 1.04 million. And that was 31.1% less than the average of the last 40 homes sold in Park City. And we did it by closing in 17 days, very high earnest money, and all cash. And so that was a great experience for us because it showed, just like when we've helped family offices close deals, like when I mentioned the $83 million worth of deals we've gotten done this year, when you offer all cash and a for sure closing, it helps even in a hot market. Back then at this time, 90% plus of homes under contract were closing. Right now, 27% of all homes under contract don't close as planned. So this strategy works even better in today's market than it did back then. Here's some quick facts on the property. Went over most of this, but the Park City area is just a really high tourist area for about 9 months out of the 12 months of the year. Here's the inside of the property. The only change is that we have a leather couch, leather chairs at the table, and we've got a 70-inch TV right below where the camera is positioned here. But it looks out of the trees. There's empty lots on both sides of the property, so it feels like you're really secluded out there. We put double bunk beds and sometimes triple bunk beds in different houses to boost the number of people that sleep at the house. That's important. Many properties in many cities, you might have 500 to 3,000 Airbnb options, right? But if you look at the number that sleep more than 8 people, it drops off. More than 10, it drops off again. And then it really exponentially drops off at 12, 14, 16 people. So we just rented a beachfront property in Folly Beach in South Carolina. And we had 3 families in there, but there was 2 options. We could pay $2,400 a night or $1,600 a night. Those are the only 2 options if you wanted to be at the beach over Thanksgiving. So, and that was 2.5 months out when we booked that. And so that's the thing. If you have multiple families, if you got multiple people sharing the bill for it, they can pay more per night, and it makes your property more unique. Second strategy is to look for wedding options. It could be a barn used as a wedding reception venue. It could be used for a wedding party for staying a night over in the area, not necessarily the actual wedding ceremony. It's just something to keep an eye out for in the space. It's something we look for because there can be increased revenue demand from that. The first day that our property in the Grand Canyon went on the market, we got a wedding party that booked with us. And that was not a surprise to us because 800 people a month look for a Grand Canyon wedding on Google. And so there's, 25 people a day looking at Grand Canyon wedding details. So this is something where people will spend extra amounts of money because it's their wedding and because family members are coming in for this one event. Strategy number 3 is to get a large acreage property, and then we can put down, usually would want one with 1 property on it already. And then we could put down 4 or 5 mini cabins around it to create a family retreat, or 1 cabin every 10 acres. And we plan to have over time, over 1,000 acres worth of land within our platform. And we hope in this first fund to have between 200 and 500 acres of land. And what we can do is put down additional units. We could put down Airstreams and rent those out if we wanted to. We can also put privacy fences between the properties. So to somebody coming to the property, it just looks like one asset on one property, and they don't realize that these are 8 different Airbnb assets that are on just one parcel, basically. But if we can carve up the tax lots, or if they already are carved up and we're buying them as a package, we could build these out and then carve off 1 or 2 packages to lower our cost basis, and that adds value. So we're forcing appreciation through this type of a strategy by adding a lot of value to the property and taking something that was not very productive and making it a really productive asset. So we have data tools we look at to see the level of demand, competition, what we could charge per night, and what something would go for in the area to help us with that strategy. Strategy number 4 is to combine multiple listings into one. So this is something that I don't think is really apparent to people outside the space. And that would be, let's say you buy these 6 tiny homes, which looks like it's in Canada somewhere. So if you bought these, and you could rent them out individually as 6 different units, right? But if each one sleeps 2 people, you could also rent them all out to one party for sleeping 12 people. And having a listing that sleeps 12 people is much more unique than sleeping 2 people, and you can charge a premium for that. And so you have to manage, obviously, if one of them goes offline, you can't rent all 6 now as a group, right? So you have to manage that. And a lot of mom and pop operators don't want to manage that level of complexity, or don't even think of listing it as a combined unit. And what we're finding is that the gorillas in the space who manage 500 or 1,000 plus homes for other people, and they're the big property managers, when we hire them to manage our properties, we have to babysit them all the time because they're overlooking dozens and dozens and dozens of properties, and they won't be 100% on the ball because they have so much going on and so many properties to look after. They only care so much about ours at the end of the day. And so we have to manage our managers when you deal with the big gorillas that you think would have everything dialed in and be amazing. It's just not the case in the space today. And when you deal with the average Airbnb property manager, they own 2 to 4 homes that are all in Sedona, or they own 1 home or 1 mountain home, and they don't use industry leading software programs or best practices or strategies like the ones we're talking about here today we're finding. So there's a real gap in the market between the gorillas who are not doing a great job and the mom and pops not doing a great job. the only people we see doing a great job are the mid-level private equity type groups in the space that are very motivated to maximize returns for investors through strategies like this. All right, one asset we just picked up about 2 weeks ago was a property in Sedona. If you haven't been there before, it's amazing. 3 million people a year go to Sedona for a reason. It's awesome. It's about a 2-hour drive from the Phoenix airport. Definitely recommend it if you haven't been there. It was a 1-acre asset, and we picked it up for, it was listed at 1.2 million. We picked it up for 925,000. And it appraised at $1,050,000 while valuing the casita at $0, which is worth probably $150,000 to $200,000 to build a casita right now. And this property, I'll show a picture of where it is here. If you drive down this road, it's El Camino Road, which is on the front of that property. If you're watching along visually, you'll be at the main street on your left. You can actually see the main street up there in the top left-hand corner. You could walk there. And when we went to the nice Italian pizza place in town, it was literally 3 minutes on our GPS to leave the driveway and then go to the Italian pizza place. So it's a great location. It's over an acre. There's actually 3 buildings on the property. And as we renovate it, we'll probably have it online by January. And as we renovate it, it'll be able to sleep 30 different people in the property. And almost no properties in Sedona can sleep 30 people. And when we have these properties going in the investment portfolio, one thing to note is that when you invest with us, you get a K1. We do bonus depreciation, cost segregation studies on all of our properties. So this property, we're trying to rent out for 2 or 3 days in late December. So it's in use this year and not next year. And you get quarterly wire transfers for the cash flow and the profits that come out of all of the properties in the portfolio. So you're getting your money off the table. We're not holding on to your money for the full investment period to maximize that return. We're giving the cash back to you. So you sleep at night knowing that things are going well and you can put that money to work somewhere else. And then what we're doing is closing on 20 transactions within our Airbnb fund. So one transaction could be 300 acres with a cabin on it, and we're adding additional properties. One transaction is the Sedona property here with 3 buildings on it that will put a privacy fence between them. One investment could be a co-investment into 7 properties. And so those 20 transactions will make up the fund in the portfolio. What'll happen is over 5 to 8 years, we're trying to double your money in our fund. And so you'll get your quarterly cash flow. And in that 5 to 8 year window, what we'll do is we'll sell 10 of the 20 transactions. We'll sell off into the market as a package and individually as needed. And then that will give you a long-term capital gain. And then we will refinance the remaining 10 properties. And then that will get you to a 2x return between the cash flow, the long-term capital gain of selling half the portfolio, and then refinancing the portfolio. And the reason we do that is that after running our investor club for 15 years, we've seen that investors complain about misalignment. They complain about high fees or just misaligned fees, right? Like when you invest into somebody's fund and they charge you an acquisition fee and an annual management fee, what they're really doing is saying, we haven't made you any money yet, but we're going to charge you this money because we promise we really are going to make you some money, but they haven't yet, right? They've just tied up your money. It's just an opportunity cost at this point. And so we've just tried to create the ultimate alignment with this type of a structure. So we don't charge $1 of asset management fees. We don't make a profit anywhere in this model until you've gotten all your money back and you have doubled your money. And we don't know anyone else. There's not many Airbnb funds, period. And we don't know anyone else in the real estate world who is saying, we don't charge you anything annually. We don't charge you anything upfront. There's no acquisition fee, no disposition fee, no annual asset management fee, no capital raiser fee. We're not charging you any fees. And we are doubling your money before we benefit at all. Your returns are capped at the 2x return plus vacation benefits, unless you're a big family office and you can put 500,000 or $1 million to work. And then we can always look at doing co-investments together at that level. But otherwise, we're getting you a 2x return before you're charged $1. And that way it's a clean stream of return to you. So you can put your money back into another one of our funds or one of the many deals that come through LFI. So we'll go over that model a little bit more later, but I just want to make that clear in case anyone does jump off early. They're super clear on what makes this unique. It's not only a different food group of real estate you're investing into, but it's one that you can go and visit and use as an investor. Have fun coming to Sedona, have fun going to Park City, have fun going to beach locations we have, et cetera. while also your money gets doubled before we benefit. So you know that we have the ultimate alignment versus other groups that charge you a lot of fees upfront and annually. With Airbnb, we're also taking the no fee clean approach. If you go to an Airbnb search for any city and you look up Philadelphia on Airbnb and you look at the properties, it'll say $299 a night for the property. And if you just stay there one night, well, the cleaning fee might be $299 as well. And then Airbnb charges you a fee. And now all of a sudden, what you thought was going to be $299 is actually costing you, $720 for one night. And you say, oh, well, what is this racket? I thought it was $299 a night. And it almost seems like a bait and switch. And Airbnb realizes this and they don't like it. And it's bad for them because if you go to Marriott, maybe a few annoying Marriotts charge you a resort fee for stuff that nobody uses. But most of them, you're just paying a nightly rate and that's your rate, right? It's very clean and clear. And so with Airbnb, they now incentivize hosts like us to embed their fee into our nightly rate. Because if I charge the guest pays, let's say, a 15% fee. But if I don't charge the guest and I absorb it, I'm only paying, let's say, for example, a 13% fee. And so in other words, the customer net is better off if we just absorb that fee. And big tech algorithms work based on a whole bunch of if-then statements on who's going to rank the highest and who makes the big tech company the most money. And so when someone searches on Airbnb, a couple hundred factors go into who ranks the highest. But I can almost guarantee you that they're having people who have taken the bait on embedding that fee and making a cleaner experience for the customer are going to get a superior rank on Airbnb, and they're going to push those properties because it's just a better experience. What they haven't done is incentivize people to embed their cleaning fee into the nightly rate because everyone's cleaners are different in every city. So it's pretty hard for them to do that, right? It's not like 13% or 15%. But we've gone ahead and done that because we see the writing on the wall, and we've dealt with Google and Facebook and Twitter and YouTube and Airbnb and Amazon. And we've been around long enough to know how a lot of these big algorithms work. And so we don't even charge a cleaning fee on our properties. If we see the average stay is 3 days in Park City and our cleaning fee is $300 usually, then what we do is just charge an extra $100 a night. And okay, sometimes we'll have someone come in for only one night and we don't make as much money. And we could always say minimum 2 nights if we're really worried about that. But if they stay for more than 3 nights, we make a little bit extra money, but it's just a very clean experience for the customer. And we think it helps us rank better and stand out. And we're able to say no cleaning fees on our listings. And almost none of our competition can say that. So that's strategy number 5. Before I go on to 6, I guess, anyone have any questions about anything I've mentioned on the strategies or the structure? If not, I'll keep going, but I'll keep an eye on the chat in case questions come in, but I don't want to just ramble on the whole time without making it interactive. So if there's any confusion over terms or questions, just feel free to send them in. Yeah, so Matt's asking, are we using debt? Yes. So we love to sell our finance deals when we can. The last deal we did, or a couple of deals ago now, I guess it was, we got seller financing on an off-market deal. I'll show that example later. So we just did 25% seller financing, put 75% down. Our average LTV is 50% across the portfolio. We're aiming for around 50% debt. The reason is that if, God forbid, 3, 4, 5 properties go offline at once, we're protected because we have very high quality insurance that not only replaces for fire and water damage, but also liability if somebody breaks their neck on the stairs at a property. Or if we have a hot tub, we have a special rider insurance coverage for the hot tub, which is super critical, by the way. And we also have revenue replacement in the insurance. So if a property goes offline for 2 weeks or 2 months, the insurance company will pay us out the revenue we should have gotten from the property. But we still want to make sure we're not in a position where we're not producing cash flow, even if 2 to 4 assets went offline at one time. And that's why we don't do really high debt. Also, we'll sometimes co-invest with a construction partner. And other people love to put 75% debt on everything they touch, it seems. And we're just relatively conservative people. And so on some of our deals, we'll only have 25% debt, and it balances out when we co-invest with somebody who really always puts 75% debt on their deals. But great question, Matt. If anyone else has questions, feel free to send them in. Strategy number 6 is to convert garages. You can oftentimes, if you're in an area where it doesn't become icy and snowy or doesn't get to 120 degrees like Scottsdale, where I'm based, then you may not need a garage, right? If you're in a moderate temperature beach location and the house is going for $700 per square foot, and you could convert the garage by only spending $100,000 and get another 800 square feet converted, then you're creating a ton of value in that house for when you sell it one day. But also you get to add extra bedrooms and you can sleep more people in that house. So when you can convert a garage, you don't have to touch the plumbing typically. It's pretty light electrical. You have to make sure it's insulated and doesn't look like a garage anymore. But this is a strategy to boost value, force appreciation, and add value to properties and turn it from a 5-bed into a 7-bed, or a 5-bedroom to 6-bedroom. But the 6-bedroom is like the kid fun zone with 3 bunk beds and a foosball table and other things in there that just make it awesome. All right, next strategy we're going to cover here is on the arbitrage. There's not many times you can do this in real estate where, if you buy a storage property, it's not like somebody was living in the storage property before, and then you can magically turn it into a storage asset. Or, oh, it's just somebody's house, and now we turned it into multifamily, so now it'll sell based on a cap rate. That's not really possible in most areas of real estate. But with short-term rentals, you can buy a house and then turn it into a business asset. So you buy it based on the real estate value, and then you can sell it based on the cash flow. And you're arbitraging those two ways of value in a property. But you also have optionality. We could also still sell the house to somebody who just wants a house. And the more you can bundle up properties, the more you can sell it based on a cap rate, and the more high of a valuation you will get. So the more that we're able to not only get smarter as we go past the 12 properties we've invested in as of today, when we get to 50, 70, 100, 300 properties that we've invested in, we'll not only get smarter, but we'll be able to sell these packages at higher valuations. And it allows us to arbitrage even more the buying of a property and then selling it based on the cash flow multiple, essentially. So you're turning a real estate asset of a house into a business asset of a Airbnb asset, basically. Strategy number 8 is one of the ones that we're most effective on. This is identifying off-market opportunities. For one market, we looked at what are the largest properties that are most unique. We found a really nicely themed property, approached it and 2 other runner-ups, and they got back to us. We negotiated the pricing and were able to secure that deal, and there wasn't 20 other people chewing on it. Nobody else was talking to them, and they said, oh, well, we weren't thinking of selling the house, but we'd be open to doing so because we have this other construction project we want to put our money into. So if we can come to some type of an agreement, we're happy to sell it. But we didn't have to work through a real estate agent, and we got to save on those fees, and they got to save the hassle of showing the property 20 times. And so we're really good at doing this. We've done this for many, many clients. We've done this for many transactions ourselves. And we'll go through a process that every billion-dollar-plus private equity firm uses, but almost no small investment firms use. And that is, we'll create a database of, let's say, 30 to 300 properties or assets in a certain market that have certain identifiable traits. We'll then have our back office team, because we have a 25-person team that we've built up these last 15 years. And part of our team will conduct research and build me out a spreadsheet of, let's say, 150 asset owners, their names, their Facebook profile, their LinkedIn profile, their email, their phone number, and we'll systematically approach them and acquire off-market assets. We've successfully closed a deal when they wouldn't reply to us any other way by getting them on Facebook Messenger. We've done so by connecting on LinkedIn. And if you don't think this works, one of our fun hobby projects that we think long-term will be great is we bought billionaires.com last year, and we just interviewed Mark Cuban 2 weeks ago. And we reach out cold to billionaires on LinkedIn and Facebook and via email. And we've gotten 15 of them to complete our interview questions and several of them to speak on stage at our investor club events. And so that kind of proves that if a billionaire will answer our cold message, the owner of a $500,000 or $2 million Airbnb asset, is likely to at least look at your message and consider responding. So this is one of our strengths. And this is a great example of what we've learned in 15 years, helping set up 200 family offices, running our investor club, hosting 185 live events. I've been to every single live event. I'm sure someday I'll get sick and miss one, or flight will get canceled or something, but I've been to all those events. And when we hear investors talk about their strategies, it's oftentimes about how they add value, force appreciation, and focus on an area where they can add a lot of strategic insight to an asset to help play defense, but also offense on that asset. But being able, when you have a really clear mindset of what you're looking to acquire, then you can reach out to properties that meet that criteria and only be talking to ones who are potentially an awesome investment for the portfolio. So this is a strategy we get really excited about because I feel like it's overlooked by a lot of people out there and a lot of our competitors. Strategy number 9 is to use creative investment structures. This is one of our strengths. Every day we are negotiating or structuring a deal for a client or ourselves, sometimes multiple times a day. And we're good at using really creative structures. So just yesterday, I sent over, just as an example, that's not here in my PowerPoint, but just yesterday, I sent over an offer to buy a house at $200,000 below what it's listed at. It's themed as like a dinosaur themed house, really unique property on the market. It's been on the market for a couple of months. And so we're basically telling them, hey, look, we bought this other property from somebody, developed a relationship, and now we're doing a JV co-investment with them 50-50 and another asset together. Why don't we do the same here? Because you did such a good job making this house have a really unique theme. We know it's going to sell well because it is selling well right now as an Airbnb asset. So give us this better price and give us some seller financing. And then when you do your next project, you let us know. And if we underwrite it like you do and we love it like you do, then we could do another investment together. And that's creative because they're giving us a discount because we're only going to buy 80% of the equity in that house and they're going to keep 20%. And that way they have upside on the cash flow, upside on the appreciation. They're not selling the whole thing at a discounted price, but also it opens the door to us doing more business together. And that's appealing to dangle in front of them. So we also negotiate seller financing. Our last deal was a decade seller financing note paid monthly at 5.5% simple interest with no prepayment penalties. We use gross revenue royalty structures. We've closed 13 deals using those strategies. We'll buy just 51% equity interest in a property or have multiple LLC share classes. So one share class gets more of the income or less of the income, or is responsible for the debt or not responsible for the debt, et cetera. We don't have time to go through all of the creative structures that we use, but this is a big strength of ours. And many times the best deals we've gotten done are ones where people told us to go away. We're never going to get the deal done. They're done talking to us. And we say, okay, well, what about this? And they say, okay, if you do that, then we're in. And being politely persistent is one of our strengths. It took us 12 years to buy billionaires.com, following up every 3 to 6 months for 12 years. We started that in October of 2009. It took us 10 years to buy commercialrealestate.com. For 15 years, I've been running Family Office Club, and our billionaire client we've closed 19 deals with. It took us 6 years to close our first deal with him. And so many times it's following up literally 50 or 100 times over a number of years to get deals done, but creative deal structures can really help. And in a hot market, sometimes brokers don't want to hear about your creative structure. They're like, no, make an offer. We have other offers, all cash, go away if you're not going to make us a normal offer. Nowadays, people want to get transactions done. They're way more open to these creative offers than they were a year ago. So that makes it a much more exciting time to invest. Some people say, oh, well, the market is volatile right now. We don't really feel comfortable, but they felt comfortable at the top of the market when everything was going straight up at a record high, when you couldn't get a creative deal done very often. Now is a healthier time to invest because if you can force the appreciation and people are much more negotiable, you're getting a better price with a better structure, and then you're forcing that appreciation and adding value to the property. It just makes way more sense right now to invest. Just like they say, invest when there's blood on the streets. Like when people don't want to invest, in my opinion, is the time when you should be looking at investing. And when everyone is super hot on investing and the market's at all-time high is when you should be cautious, right? Here's a headline from the Wall Street Journal. This is from 2 months ago now, but things have gotten slightly more harsh since then. The luxury home market posts its biggest decline in a decade. It's like crickets. So when do you want to invest? Like after it's had its biggest increase or right after it's had its biggest decline in a decade? Ray Dalio, Jamie Dimon, other types. I'm very informed of what they're always saying because of the Family Office Club business we run. And while things may continue to get potentially worse through February, March, April, June, who knows? Who knows if Biden will print another $1 trillion, get reelected, or something else unexpected will happen. Nobody knows. But it's way more negotiable right now. And the possibilities to get a oceanfront property, which we're looking to close on by January and close on some other exciting deals that we're negotiating, is really kind of unheard of. And one deal right now that's going in the fund December 9th, we need to bring in $250,000 to close on this transaction by December 9th. So if anyone's listening, your capital would go into the fund into all 20 transactions, but one of those 20 transactions will be this one. Is we've identified a portfolio of 57 Airbnb properties where over 40 of them are already cash flowing and renovated. The other ones are being fixed up to be cash flowing in the next 6 months. But we have structured a really unique structure that proves the point of this slide. We're getting a 16.5% preferred return and then a 50-50 profit split after that. In all of the webinars you've ever listened to, not just through LFI, but your whole entire life, who has offered you a 16.5% preferred return? I can tell you it's nobody, because I've been doing this for 15 years and no one's ever offered that to me. And we see 1,000 deals a quarter. Why would they do that? Well, they want access to our billion-dollar balance sheet partners. They want access to the publicly traded entities that we work with as well. So they said, oh, Richard, I know that you could see us as a competitor, but why don't we see each other as collaborators instead? And we leverage the muscle of family office club influence and use that to help our investors, because the better you do, then the better we do, the better we look, and the easier it is to raise the next fund, right? So we're always looking at ways like, how do we leverage what we've been spending 15 years building to get amazing deals into this portfolio? And that's an example of one way, is the 16.5% preferred return with the 50-50 profit split after that. And the other deal we got done that we wouldn't have gotten done without that same influence was a co-investment into a portfolio of 7 homes where the homes were already bought and renovated, and they're looking to sell the portfolio, and the value has already been added to the homes. They're already de-risked because they're all cash flowing, and they were bought in 2021 early in the year. They've already appreciated by 50, 60, 80%. And we were able to get into that and go back in time and invest at the exact same valuation as people that invested in January 2021. And we got to turn back the clock and put some money into that portfolio of 7 homes, again, to build trust and build the relationship in that area. So we get excited about stuff like that. If some of you have looked at a lot of deals, you'll understand, what I'm saying, I believe. But if you have any questions about that, let me know. Peter's asking about minimum investment. Yeah, on purpose, we made the minimum just $25,000 for this fund so people can get to know us. You could put in $25,000 and then put in another $25,000, $50,000 come the start of next year or in the next fund or whenever you feel comfortable and see the number of assets we've closed and the exciting deals we're doing. Most investors come in for $100,000 to $250,000. Most doctors and dentists are coming in for the $150,000 to $200,000. And then if you're a family office, most of those investors are coming in at $500,000 to $1.3 million. So we have about 7 to 8 million of commitments for the fund. Some of those from investor clubs. The money will roll in over time. And those are the 3 kind of sizes of investments most people are making. And one way to think about it is that when you invest, you're getting not just 20 properties, because remember the Sedona property alone, you're getting 2 properties with 1 investment. But so let's say our average transaction has 2 properties on it to make things simple. You're basically getting access to 40 properties when you make 1 investment. So if you invest $40,000, you're basically investing $1,000 per house. So it makes it sound way less, right? It's not like you're buying 1 storage facility. These are assets in different markets, bought at slightly different points in the economic cycle, all starting once the slide was already happening a couple months ago. And so you get different points in time and different geographical markets that have different regulations, different seasonalities, et cetera. Got another question here about cash and cash return. Yeah, so we're aiming for a 7 to 9% cash on cash return year 1, and then 8 to 10% over time. Different properties will have different value add needs. Some properties we have to do construction for 2 months. Some are like the Grand Canyon property we acquired. It came with $55,000 worth of bookings that transferred over. So we had receivables when we came on, and it was already a productive asset. So we literally, the day we closed, we had our first customer coming in and $55,000 worth of future bookings that we inherited and we got like for free, quote unquote, as part of the deal. And so the cash on cash will change that first year, because until you have a lot of ratings, you have to charge slightly less. And we sometimes need to upgrade the pictures, even if we don't need to upgrade the operations and deck out the house with the bunk beds and TVs and couches and everything. So the first 2 to 3, 5, 7, 9 months are getting the asset stabilized, good reviews, and then we can charge more full market rate at that point. I'll tell you on our Grand Canyon property, we were trying to bring in $12,000 a month And our first month on the market, we're brought in for November $17,000. And in December, if nobody cancels and we don't sell a single additional night, which we definitely could, we're only about 60% full right now. We're booking 19,000 in revenue for that second month. So we're above estimates there. And summer is the real hot period for that area. So we're excited about how all of that is going, but not every asset's going to start out going better than expected, obviously. Heather's asking concerns about Airbnb market regulations. We have a short-term rental expert on our team that worked at Inspirato and AvantStay that manages 550 and 800 homes each. And she's head of property management. What she does when we look at our top 10 target markets, because we're open to, if anyone has a short-term rental asset in their portfolio, especially one that sleeps a lot of people or is in an awesome location, and you want to sell part of that to our fund, or instead of investing cash, invest that property in lieu of cash into the fund. That is a way that we source properties for the fund. That is an option. But for every market we're targeting and proactively going after, Jen on our team prepares a market analysis of regulations. In some places, you have to rent a minimum of 1 week. Some places, a minimum of a month. Sometimes you have to go through 19 hoops to get approved, but almost everyone gets approved. It's just this annoying process you have to go through. So what it does is it weeds out some of the mom and pops. It weeds out some of the people who are just doing it part-time or are not serious or don't take good care of their neighbor's experience of having an Airbnb next door. And it makes it so you can charge more per night the tighter regulations get, as long as they're not so tight that it's basically illegal to have an STR. Hawaii is the worst. You know, Lake Tahoe and Sedona is not super friendly, but sometimes at the state level, they have to allow Airbnbs. They can't make it illegal if they wanted to. And one thing we're doing in Hawaii is we are shopping for off-market motels and boutique hotels, because then we can run it as a hospitality asset and sell the rooms on Airbnb. So we hope that by Q1, we have some exciting news about a hospitality asset in Hawaii as part of the portfolio coming up. That's one way we plan on navigating it. George has a question. Do you plan on investing in other international markets outside the US? Yeah, for sure. I'm going to Belize in January to look at a couple assets down there. We're also looking to pick up an asset in Bali, and we're looking at Costa Rica, Panama. We're not sure yet on Mexico, and 80% of our international investments, at least for now, will probably be British law locations. Most important for us is to have a really aligned partner. So one thing in Belize that gives us a huge edge is a family office there, someone worth $150 million. They went through and literally read every word of the PPM and went through all of our due diligence email documents and background check on myself that we have on our Dropbox data room, et cetera. They're allocating $1.3 million into the fund, but they own over 4,000 acres of land in South America, and they own a Marriott they're developing in Belize, et cetera. And so if we invested in another country, it could be alongside of them, so that half of the money or 80% of the money is coming from their pocket, and we know they like the deal, or they wouldn't be putting 80% of their money in it. And then we just buy 20% of the deal or 50% with them. And that way we're aligned with a partner that he would be hurting himself if he did an investment that didn't make sense in multiple levels, right? He'd be hurting himself because he invested in the fund, and also hurting his money going into that specific deal in Belize. So we'd love to find partners like that and alignment like that. If we're going to co-invest with someone, we need to have them eating a lot of their own cooking. There's a father-son that owns $22 million worth of Airbnbs. They haven't taken anyone else's money to date. And what we propose to them is that next time they do in a deal that they're really excited about, we may tag along and buy 20% of that deal alongside of them if they give us favorable management terms and don't charge us a bunch of fees, because then we know that 80% of their money is going to work in that asset. And it's not them just trying to sell us a deal to make a short buck on us, right? Peter has another question. Any possibility of additional cash flow down the road? Yeah, so you get cash flow, and it's a return of your money, not a return on your money. So it's tax-free income that comes back for most of you until you get all your money back in your pocket. After that, it'll be taxed as income, but then long-term capital gains from the sale of part of the portfolio and the refinancing coming back to you. And so the tax treatment is beneficial. And then you get a option to stay at the properties while you're an investor. And if you stay at the properties, then part of that value per night goes towards the doubling of your money. It's like an option you have that you don't need to decide on upfront on how you double your money and get your value out of the investment. And then after you've doubled your money, you get a vacation credit. And for every $25,000 you invest, you get $600 to spend at any of the properties. So if you invest $200,000, then you're getting, what was that, $4,800 a year to stay at any of the properties in the fund.
And that was cash call, I think, Richard.
Oh, cash call. Yeah, sorry about that. In additional, no, Peter, we avoid that at all costs. So we have low debt on the properties, and we raise the money before we're putting money down on the properties. When you decide to invest, you invest that capital in real time at that time. You don't just make a commitment, then we let you know when the property comes available. In real time, we're closing on properties every 2, 4, 6 weeks. But we have really strong insurance on these properties, so we don't see any scenario where there'd be a cash call and need for more capital from the investors. We also run an investor club with 3,000 plus investors and work with dozens of 100 million plus net worth families. So push come to shove, we could always give up some of our upside or some of our participation to make the properties whole and do right by the investors to maintain the reputational risk we have of running this asset really and this fund. Will financial reporting include a detailed walkthrough of the gross receipts? Yes, we also provide bank account statements. We provide detailed financials, property management details, et cetera, super transparent with the investors. You get a quarterly report every quarter on how your investment is doing. And one of our investors is ridiculously detail oriented, which is totally fine, but he asks questions about the most minute thing you could possibly imagine. And we produce the receipts or show him that. And it's good for us because it prepares us for the next accountant, CPA, detail-oriented engineer person who becomes an investor with us. We actually appreciate that he's an investor with us. What's the LP residual basis after returning all the capital, and how is future cash flow calculated? Yeah, so every quarter we have to pay out, we have to pay our taxes, utilities, cleaning fees, property managers. But after that, the profits all flow to the investors every quarter. And with another fund, they may say, oh, we could exit the fund and give our investors a nice 1.9x return. Should we do that? Or should we hold on longer and get them a 2.2x? Or should we hold on longer and try to hit a 3x? We can brag about that for the next decade that we return to 3x, even if it takes them 10 years to do that, right? In our model, it's not like that. The faster we can get you to doubling your money, the better it is for everybody. And remember, we're not holding on to your money. You get that cash flow every quarter. But once you double your money, you're capped at that 2x return, but we're motivated to get you that as soon as possible. And so you can then put your money back into another one of our funds or somebody else's fund. And if you're not spending your quarterly cash flow on fun adventures and you're actually reinvesting that, your experience during that 5 to 8 years is going to be much more than 2x, because you can put your money into another LFI deal or another asset or another fund of ours. And so during that 5 to 8 years, you could earn, 2.4 or 2.8x on that one piece of capital you put into us, because we're not holding on to your capital. We're giving it back every quarter. So once you hit the 2x return, you're out of the deal and you have vacation credits left on the property. And some people say, oh, well, isn't that like way too good for you guys? But if you look at the math, we do 20 transactions. We're going to sell 10 of them. You get quarterly cash flow, and then we sell 10 of them to get your long-term capital gain. We refinance the portfolio. So now we're left with 7 properties that probably have 70 or 75% debt on them. And if you look at those 10 properties and say, oh, okay, well, if they have 75% debt on 10 properties, it's almost the same as them owning 2.5 properties, right? Because 25% of 10 properties would be 2.5 properties, right? And if you look at buying 20 properties and we're left with the equivalent of just 2.5 properties, it's almost like we took a 15% performance fee only, because we didn't make any other money. The only thing we're left with is these properties are going to have a bunch of debt on them at the end of the day. Plus, I've invested $550,000 of my own cash in the properties to date, and we're going to get that to 7 figures by Q1 as I sell off a multifamily asset and a home in Florida that we have on the market right now. But the point is that some people have never seen the structure. Almost everyone says I've never seen this structure, and they're like, what? Why would I get more upside? The reason why we designed it is that the faster we 2x your money, the better. Another fund that could have 3x your money, well, then they could have 2x you in 3 or 4 years. And that's what we're motivated to do if somehow we figure out how to do that. The guidance we give is 5 to 8, hopefully worst case 9 years to double your money. Plus it gives you cash flow. Plus you get to use the properties along the way. So those are some of the unique aspects of the structure. So it's just going to work differently than other things in your portfolio. And if you are a big family office and you're putting a really big check, we can always talk about doing some co-investment rights as well. So great questions. I want to go through the last couple of slides here because I think we only have 10 minutes or so, right, Jim?
Yeah, and we did skip one question, the break-even occupancy. I'm not sure if you saw that one.
Oh, yeah. Yeah, sure. So very specific to the property, Kevin, but great question and great timing for the question, because if you're following along visually, you can see our trading outpost property here in the Grand Canyon. This sits on 2 acres. It's super cool and unique. I don't care how crowded Airbnb gets. It's going to be really hard for someone to build a property that looks and feels like this. And my computer just told me I have 10% battery, so I'm going to plug it in while I talk. Sorry. But the break-even question on this property, we're only 46% filled this month. But because it's the most renovated property in the Grand Canyon, and it sleeps 22 people, more than anyone else in the Grand Canyon, at 46% full, we're doing 17,000 in revenue this month. And next month, we're at 19,000 in revenue at 50% full. Our pro forma required us to do at least 12,000 a month average to be healthy. 15,000 was the stretch goal. And we beat that the first month. Will that happen every month? I can't promise that. There might be some down months. There might be some weird shoulder seasons that surprise us here. But in this asset, we'd probably be at break even at 30% or 28% occupancy to answer your question. And if we can get this to the industry best practice of 60, 70%, as we have the professional photographer come in on December 14th to update the pictures. We just built a dirt trike track. So if you come, you can race your kids or race your brother around the backyard of this thing because it's sitting on 2 acres. And we've got helmets and 3-wheelers that are low to the ground for kids, 8 to 12-year-olds, as well as adults. And so you can race them around. We have a playground being built in the backyard right now. It should be done today or tomorrow. All those updated pictures are just going to boost the revenue we make on this. But with some assets, we need to rent it out at 60, 70% to make it be nicely profitable. With this one, just at 50%, and it's doing great. So it'll be different based on the property. So I'm going to start going pretty quick through these next few slides. I want to make sure and get through everything, but I love all the questions. At least I know 4 people here paying attention and have some curiosity about it. So the point of slide number 10 is that you want to have unique bones to the property, not just a cool Star Wars poster on the wall or a Star Wars toy when you walk in if it's a Disney location, right? So why do people go on road trips around the West? I mean, the Old West theme matches it. This was literally a trading outpost for 50 years. And then you look at the outside and it looks like really outdated, but we renovated the inside to be awesome. And so it's that combination of really unique theme, but a great experience that is unique that people will pay extra for. So we rent out these 2 properties combined. There's a house behind this one you can't see. Combined, they rent out for $1,000 to $1,500 a night, and on their own for $400 to $600 a night is basically what the math comes out to. And so here are some of the numbers. 3 million tourists a year to the area, just like Sedona by chance. Also is 2 acres with 2 properties on it. We had 55,000 in receivables the day we closed. They asked for 1.5 million. We got it for 1 million and the furnishings, which cost us 150,000. We on purpose valued the furnishings slightly generously because those are pure bonus depreciation. And we want to be able to get that negative K1 to our investors in good shape the first year in. And this is one that was sourced off market by looking at some of the biggest, most unique properties in the market. And we got seller financing on it. So I already talked about some of the revenue numbers I have on there. So we'll keep on going. But if we sold this today based on the revenue we're doing, it should be worth 1.4, 1.5 million based on a cap rate valuation. But those are super early estimates. This just came online with us about 6 weeks ago. And I'll get to your questions in just 1 minute and I get through these slides. This is what the inside looks like, right? Totally different than the outside. Look at this and you're like, man, what's the inside of this thing going to be like? But it's all super renovated, modern, updated. Here's the kitchen. Here's the bed. It's actually floating off the ground with the light underneath. Looks really modern and neat when you see it there in person. This is another property that we invested in Orlando. It's like kind of a castle themed because people are going to Disney and they see this and they think, wow, we're already spending like $2,000 to get into Disney for 3 days for the 5 of us. And if we stay at a Disney hotel, it's going to be $800 a night or $1,000 a night. We could stay at a property like this, have both families stay in the same spot and be more relaxed than in a hotel lobby trying to get your Uber Eats in or something like that, right? So it's a little better experience for a family. So in summary, and I'll get to whatever other questions came in, if you invest with us, you're basically leveraging our 15 years running our investor club, and you're getting exclusive experiences. You can come and stay at the assets if you want to. If you don't want to, you just get cash on cash, double your money. If you want to stay at the properties, part of that nightly rate just goes towards that value of doubling your money. If inflation continues, then this will be a protection against inflation because the value of the properties and the nightly rates will go up with inflation. And also market appreciation, you'll be capturing here. It'll double your money faster if the market appreciates. If it slightly depreciates in the short term, real estate has always gone back up to record highs over time. And a lot of people think interest rates will come back down in 2024, 25. 25 is the most common expectation I hear from experts. That we think we'll be able to ride this through the cycle and acquire amazing deals over the next 3 to 6 months, like we already have been. And you get quarterly profit shares. So the cash is coming back off the table to you. We're not holding on to your money and you're just hoping our quarterly reports are true. You can go and actually visit the assets, see the assets, see the quality of them and how unique and fun they are to stay at. And then kind of get what we're trying to do and buying really unique properties and adding value to them to force appreciation. So this is something your whole family can enjoy. And at the end of the day, you have a lot of investments in your portfolio. And whether you're worth $9 million or 10.5, or you're worth $3 million or 3.25 million, this is giving you the cleanest return stream without charging you any fees that I've seen in 15 years. That's why we designed it this way on purpose. But also, what are your kids going to remember? That you're worth 3.2 million versus 3 million? Or are they going to remember the family vacation at a beachfront home, or going to the Disney themed home, or to the Grand Canyon, or to Park City? Most of the ultra wealthy people I know, they should be spending money on their health. They don't. They spend money on novel new experiences and travel, and they travel nonstop when they have a lot of money and they've met their other basic needs in life. And so as you grow and become wealthier, investing in things that give your family experiences and really building your legacy around having a fun time and creating priceless memories with your kids and spouse, or coworkers, or gifting nights at vacation properties to your employee of the month or your best salesperson of the quarter, are things that you can do to really have a unique investment here. That's not just good for your money, but good for building your legacy and memories. So this is our team. Lots of investment companies have 2-person teams, 5-person teams. You know, we have 25 people on the team now. It says 22 here, but we've added several people to the team since I put this slide together. Jen Myers is a critical part of the team because she helps manage all of our properties on a day-to-day property management, you know, day and night property management basis, basically, as well as Laura Clay, who's the head of our investor relations. She's someone you may be speaking to if you end up investing with us and getting to know us better. Don't forget, one way to get to know us and make sure that all these faces are real is you can shake all their hands at our Family Office Super Summit. I also, you know, I'd encourage you to come at least for one day or a half day and check it out at the Fort Lauderdale, the Westin Beachfront Hotel as an LFI member, because you can meet me, you can shake hands, you can meet a lot of our team there, see the quality of people on stage, see Jim there and say hi. And really see that it really is all real. I also did a background check on myself through VCheck. I paid $1,700 for that. And if you want to call them and make sure I didn't make up 17 pages of things on myself, you could do that. And that way, you know, I am who I say I am. And I know that's half of investing is just like, is this counterparty real? Is what they're saying real? Is this strategy real? Is this really going to work? Is this some sort of trick or weirdness going on here? And for 15 years, we've been building up our reputation. And so we wouldn't blow it by taking shortcuts. We're going to do really well by our investors here. In summary, we can put your capital to work into off-market assets, reduced price acquisitions by making all cash offers. We'll force appreciation and purchase things based on a real estate value and sell it based on the business value, based on a cap rate valuation. We'll provide you quarterly cash flows. It'll be a tax efficient stream of capital coming back to you, and you double your money before we make a dollar off of you. Nobody else has probably said that to you in showing you an investment. And that's exactly why we designed it that way. You can stay at the property one night a year for every $25,000 you invest. And at the end of the day, what we try to design here is a low risk investment. These are 50% LTV properties in all different markets with great quality insurance on them. And it's going to get you a good to really great return with really great experiences along the way. So we hope you find that combination compelling. And I'd be happy to schedule phone calls with you, with myself or with Laura, to meet you at the Super Summit, answer any questions you have here on the webinar, or you can reach out to me directly. I'll check questions in 10 seconds here, but if you want to shoot me a text message, it's just 305-333-1155. Or you can email me at richard@investorresidences.com. And we have a question from Matt. Any thoughts regarding the potential for decline in demand of vacation rentals as economy contracts going forward? Well, I can't predict what would happen if there's an all-out World War III or some sort of thing that's worse than the mob going into the Capitol building, or something like some ridiculous Black Swan event. I can't ever predict something even worse than that could happen. We don't see a slowdown. Airbnb hit 100 million nights and experiences booked last year for the first time. Inspirato, a luxury villa platform, has had record sales and growth. And Airbnb sees an increase 15% a year in demand for more Airbnb properties. But I think a bigger risk, Matt, is if you're buying a random suburbia average home, especially a small to medium-sized home, and just listing it on Airbnb nowadays, you'll get killed, because there's so much inventory on the market. You have to have a unique property. It has to sleep a lot of people. You need to force appreciation, add value to it, or have a top 10, top 5 most unique property in your area. And hopefully it also sleeps a lot of people. And that's really key to our strategy and what's going to protect us, because there's a lot of inventory increase in a lot of cities. And if there's 1,000 more units added to the market, will we still stand out as a top 1% asset or top 10 asset? And that's what we ask ourselves all the time. And we're really excited about another couple of deals we have in the pipeline now, which we can't share publicly yet, but they really meet that definition. So I'll be excited to share that as we go. Great. I think I went over by 2 minutes, so apologize for being so long-winded today on everything, but we're really passionate and excited about this, and high conviction on it, and hopefully would love to put some of your capital to work. I know a lot of you probably have, the last 20 years, worked really hard to make your money, but if you're like a lot of investors, your money isn't working too hard for you sometimes, right? Because you're trying to figure out who to trust, how much to put where, if you're timing the market right. So I'd love to put some of that capital to work for you if you're one of those investors.
Excellent. Thank you, Richard. We started 2 minutes late, so you were actually right on time, and we appreciate that. This recording will go out hopefully tomorrow, and if not, it will be out Friday. And if anyone has any questions, as Richard said, all of his information is there. You can contact him directly, or you can contact Laura. And obviously, if you're able to make it down to Fort Lauderdale, we would love to see you all. And if we don't see you there, hopefully we'll see you in LA in March. But thank you very much, Richard. And thank you to everyone who attended. We appreciate you, and we'll see you next time in the left field.